Welcome to another analysis here at Economy and World. Today, we are going to break down a situation that most investors ignore, yet it supports the very foundation of what we know as modern finance. For more than 3 decades, the global financial system has operated under a historical anomaly that very few truly understand in its full magnitude. I am referring to Japan's decision to effectively freeze the price of money for an entire generation. This was no minor decision. It was a move that transformed the yen into the world's primary funding currency and turned the Japanese bond market into the starting point for one of the largest capital transfers in modern history. But today, that fundamental pillar is beginning to crack. And it isn't happening through a sudden shock or dramatic headlines, but quietly, almost imperceptibly, as the Bank of Japan starts to slowly dismantle the scaffolding that has artificially supported its markets for years. The central actor in this drama is the Bank of Japan. We are talking about an institution that, for decades, purchased government bonds on an almost unlimited scale. Its goal was to suppress long-term interest rates and effectively remove any genuine signal of risk from its own market. The result of this experiment was a profound distortion in the price of capital, not only inside Japan but across the entire global financial system. Without intending to, Japan built the largest cheap funding machine on the planet. Banks, insurance companies, pension funds, and hedge funds learned to use the yen as the essential fuel to invest in every corner of the globe. Over time, this practice stopped being a mere investment tactic and became structural, a part of the system's very design. But here is where we must pay close attention. The real problem is not simply that Japan is now raising interest rates. The real issue is that Japan is withdrawing the implicit insurance policy that guaranteed for years that its bond market would never have to regulate itself. When a central bank stops acting as an automatic buyer, the market is forced to rediscover the true price of risk. And when that happens in a country with a debt-to-GDP ratio above 250%, the consequences do not remain confined within its borders. For years, the market treated Japanese government bonds as low-volatility assets, not because they were intrinsically safe, but because the central bank had eliminated the possibility of meaningful price declines. The moment that protection begins to fade, yields start to adjust, and they do so at a much faster pace than many expected. That adjustment is not a technical detail, it is the signal of a global reconfiguration of capital flows. This is where our second major actor enters the scene, the Federal Reserve. When movements in foreign exchange markets intensify and the yen becomes unstable, central banks activate coordination mechanisms to prevent a liquidity dislocation from turning into an international funding crisis. It is crucial to understand this. It is not about rescuing Japan. It is about protecting the global payments and funding system that relies on the dollar and the yen as structural currencies. You might wonder, why does this episode have direct implications for my investment portfolio? The reason is very concrete. For decades, Japanese investors were massive buyers of U.S. debt. In fact, Japan became one of the largest foreign holders of U.S. Treasury bonds. That structural demand helped keep U.S. yields artificially low, benefiting everyone from the government to the average home buyer. The mechanism behind this was extraordinarily simple, yet powerful. The carry trade. Investors borrowed yen at near zero interest rates, converted those yen into dollars, and used those dollars to buy U.S. treasuries that offered much higher yields. The spread between the two became an almost automatic source of profit. For years, it was one of the most stable and predictable strategies in the international financial system, but that stability depended on one critical condition that has now ceased to exist: that funding costs in Japan would remain permanently depressed. As Japanese bonds begin to offer progressively higher yields, the appeal of holding U.S. debt immediately diminishes. However, the truly fragile point is not the loss of profitability itself, but the balance sheet structures that were built on top of that spread. For more than a decade, this was not limited to conservative investors. Hedge funds transformed the carry trade into a highly leveraged strategy, where a traditional investor captured 2 or 3 percentage points of yield differential. Leveraged funds multiplied that exposure 10 or 20 times. The result today is a mountain of positions that are extremely sensitive to relatively small changes in interest rates and exchange rates. When Japanese yields rise, the margin of safety for these strategies shrinks rapidly. And when the yen begins to move with greater volatility, the cost of hedging currency risk surges. At that point, the mathematics behind the trade simply stops working. This is where the first truly systemic risk emerges. It is not a matter of Japanese investors calmly selling their U.S. bonds to rebalance their portfolios. It is about a significant portion of the market being forced to reduce exposure purely because of risk management rules and collateral requirements. These sales are not strategic investment decisions. They are driven by margin calls. This distinction is essential to understanding why this process is usually neither orderly nor gradual. When leverage comes under stress, the market stops distinguishing between good assets and bad assets. It simply sells whatever can be sold. That dynamic connects us directly to the heart of global financial markets. A large share of institutional capital is concentrated today in a small group of extremely liquid U.S. companies. Firms like Apple, Microsoft, Nvidia, Amazon, and Meta have become the primary adjustment vehicle when large funds need immediate liquidity. These companies are not vulnerable because of their underlying businesses, which are usually excellent. They are vulnerable because of the function they serve inside the system. They are the deepest and most efficient instruments for raising cash in minutes. That is why during episodes of financial stress, they are often the first assets to absorb large waves of selling. This nuance fundamentally changes how we should interpret market drawdowns. When liquidations are driven by forced flows, prices stop reflecting long-term economic value and begin to reflect funding needs instead. That type of decline can extend much further than fundamental analysis alone would suggest, but the impact doesn't stop with equities. The second transmission channel is the U.S. bond market itself. If large foreign holders begin to reduce their positions, long-term Treasury yields come under upward pressure. And when those yields rise, the entire financing structure of the economy becomes more expensive. Mortgages, corporate credit, and business loans are all directly linked to that yield curve. An adjustment of only a few percentage points can translate into a massive destruction of credit affordability. That is the real mathematical link between what happens in Japan and the housing market or consumption in the West. When yields rise, mortgage payments rise. When payments rise, demand falls. And when demand falls in an environment of high leverage, prices eventually adjust. This brings us to a haunting conclusion. The deepest risk in this episode is not in Japan, nor even in the U.S. bond market alone. The real risk lies in the mental architecture with which most investors have built their portfolios over the past few decades. The idea that when equities fall, bonds will always provide protection. This principle, that bonds protect you when stocks fall, is not an immutable economic law. It is simply the result of a very specific monetary environment that is now coming to an end. For decades, every time the economy faced trouble, central banks cut interest rates, yields fell, and bond prices rose. This dynamic offset equity losses and created the illusion of a stable hedge. The problem is that this mechanism only works when the market has full confidence in the issuer's solvency and the central bank's ability to intervene. But when stress originates within the bond market itself, that protection simply vanishes. This is what we call a correlation breakdown. Stocks and bonds begin moving in the same direction, not by statistical coincidence, but because both are being sold simultaneously by the same participants. We saw this clearly in the United Kingdom in 2022. The government bond market entered a selling spiral that forced the Bank of England into an emergency intervention to prevent a collapse of the pension system. That crisis wasn't caused by a conventional recession. It was a sudden loss of confidence in fiscal sustainability. In days, bonds crashed, yields spiked, and stocks were dragged down by forced liquidations. That episode delivered an uncomfortable lesson. When the asset assumed to be your always safe haven enters its own crisis, your hedge disappears. This is exactly the scenario taking shape as massive blocks of sovereign debt enter a phase of structural adjustment. Japan is the catalyst, but the entire system is the transmission mechanism. This leads U.S. directly to the most widely used portfolio in the world, the classic 60-40. For a long time, a portfolio of 60% equities and 40% bonds worked because the dominant risk was the economic cycle. But today, the dominant risk is financial structure risk. When rising interest rates are the source of stress, the traditional portfolio becomes vulnerable by design. This doesn't mean the model is permanently dead, but it does mean that during deep financial tension, it can behave like a highly concentrated portfolio because both sides are exposed to the same underlying factor, the cost of money. In the current environment, defensive management cannot be reduced to just trimming stocks and adding long-term bonds. If markets enter a cross-asset liquidation phase, the adjustment hits both sides at once. Furthermore, many institutional managers have spent years assuming that every correction would be met with rapid stimulus. That reflex may no longer work as quickly. Central banks are now caught between financial stability and price stability. Protecting the system requires easier money, but protecting the currency's purchasing power requires the opposite. In that unstable balance, prolonged crises are formed. Risk management must now be grounded in balance sheet structure, not optimistic narratives. The first step is understanding your aggregate exposure. It's not enough to know your percentage in stocks or bonds. What matters is your exposure to the cost of capital and global liquidity. A portfolio heavy on broad indices and long-duration fixed income is essentially a single-factor bet that sovereign yields won't rise. There are indicators you must watch closely. The U.S. 10-year Treasury yield is the thermometer of global stress. Every time it breaks key levels, it triggers automatic rebalancing in quantitative models. Another critical indicator is the USD-JPY pair. It's the best barometer for measuring how fast yen-funded strategies are being unwound. When the yen appreciates rapidly, it's a signal that capital is heading home and international positions are being closed. When financial tension becomes structural, the conversation shifts toward real assets. But many make the mistake of confusing a safe haven with an asset that simply goes up in price during a scare. Gold, for example, serves a very specific role. It isn't meant to outperform the market when things are good, it's meant to preserve value when confidence in governments and central banks weakens. Gold is not a company. It has no cash flow. Its value is purely monetary, making it essential when the sustainability of global debt is questioned. Silver shares some of that role, but its industrial component makes it more volatile. In an economic slowdown, industrial demand for silver can drop, adding a risk that gold doesn't have. Meanwhile, digital assets, despite their promise, tend to behave like high-risk assets during crises. They are sold aggressively because they are liquid and easy to turn into cash. This doesn't negate their long-term value, but it does invalidate the idea that they are an immediate refuge when panic hits. We must also be wary of the cash trap. In times of volatility, the urge to flee to cash is natural. Cash is necessary for operations and emotional peace of mind. But it is not a long-term store of value, in an environment of structural imbalances. If the eventual response to a crisis is printing more money, the purchasing power of that cash will erode. Cash is a liquidity tool, not a wealth preservation tool. So what is the path forward? Defensive positioning today means truly diversifying your sources of risk. First, reduce reliance on assets sensitive to long-term rates. Second, review exposure to highly indebted companies that depend on constant refinancing. In a world of restrictive liquidity, balance sheet quality becomes far more important than revenue growth. The market is moving away from future expansion stories and toward financial discipline and operational resilience. This process, the unwinding of yen strategies and the reconfiguration of global flows, is not a one-day event. It could last for quarters. Volatility will not be an isolated event, but a persistent feature. This is why a staggered adjustment of exposure is often more effective than sudden, impulsive moves. The greatest danger today is not missing a temporary market rally. The greatest danger is remaining exposed to an investment architecture designed for a world that no longer exists. For over a decade, we grew accustomed to artificially low rates and abundant liquidity. That regime allowed for levels of risk that are now incompatible with reality. We are not facing a sudden crisis, but a transition from a system sustained by ultra-cheap funding to one where capital finally has a real price again. When capital has a price, leverage is no longer invisible. The math that favored expansion for years is now playing in reverse. This is the true backdrop of our time. It's not just about Japan. Japan is simply the trigger. The transition is already underway, and ignoring it does not eliminate the risk. Adapting in a prudent, structured way is the only realistic path to protecting your wealth during this profound shift in the global financial system. Well, I hope this analysis has been useful in helping you understand the threads that truly move the markets today. This is our perspective on a regime change that is only just beginning. And as always, the goal is to provide you with the tools necessary to protect your wealth. If you enjoyed the video, don't forget to subscribe and hit the bell icon to keep analyzing the pulse of global finance with us. Thank you for joining us once again here at Economy and World. We'll see you in the next video.